On behalf of Axis Bank, I welcome all the participants to the conference call once again. On the call, we have Mr. Amitabh Chaudhary, MD and CEO, Mr. Puneet Sharma, CFO, Mr. Rajiv Anand, Deputy MD, Mr. Ravi Narayanan, Group Executive and Head, Branch Banking, Retail Liabilities and Products, and Mr. Sumit Bali, Group Executive and Head, Retail Lending and Payments. I now hand over the conference to Mr. Amitabh Chaudhary. Thank you, and over to you, sir.
Thank you, Nirav. Good evening and welcome everyone. Financial year 22 was yet another extraordinary year. You could say these kind of years are coming thick and fast now. We had the impact of wave 2 in the first half, a strong rebound thereafter, and macroeconomic headwinds because of war and rising inflation by the time we ended it. At Axis Bank, we took these uncertainties in our stride and viewed them as opportunities to redraw the baseline in multiple business segments. We gained market share in them, and we made significant progress on our journey of distinctiveness. This has been possible through the collective efforts of our employees and partners who serve the needs and aspirations of our customers. I will share with you how we have fared on the execution of our strategy in the years gone by. Puneet will give you the details of the financial performance. We focused on the three core areas of execution to move forward on our GPS strategy. The first one was deepening a performance-driven culture. Second was strengthening the core, and third was around building for the future. Let me now discuss each one of them in further detail. On deepening of the performance-driven culture, growth has accelerated across the bank, driven by a culture of high performance and relentless execution. First, we have lifted the growth trajectory. Our CASA deposits have grown at a CAGR of 15% in the last 3 years and 16% year-on-year in financial year 22, led by our focus on granularization and premiumization of deposit franchise. On advances, we continue to grow faster than the industry, with overall advances growing at 15%, while the growth in our focus segments, comprising mid-corporate, SME, small business banking, and rural, has been higher at 17% CAGR in the last 3 years. On credit cards, we are seeing huge customer interest in our proposition. We have grown 26% over last year, and we issued a total of around 2.7 million cards during financial year 22. We have gained significant incremental market share of 31% in 11 months financial year 22 on merchant acquiring business. We are the second largest merchant acquiring bank in the country with an installed capacity of 9.52 lakh terminals. We have built our Burgundy franchise to be one of the top brands in wealth management space. We now have an AUM of rupees 2.6 lakh crores, growing at a strong 25% CAGR in last 3 years. Second, we are improving our profitability metrics. Net interest income has grown at a CAGR of 15% in last 3 years, despite the COVID challenges. PATA CAGR has been 41% in last 3 years. Our subsidiaries continue to deliver industry-leading performance and remain an integral part of our One Axis strategy. They delivered 51% CAGR in profits in the last 3 years, crossing the rupees 1195 crore mark and contributed 80 basis points to Q4 financial year 22 annualized consolidated ROE of around 6.67%. I would like to reiterate that our aspirations are bigger and we continue to work to raise our performance on margins. Third was around fostering a winning mindset. There is a positive cultural change in the bank and in our ability to stand out in the market. This is reflected in Axis Bank delivering many industry firsts and winning external recognitions for its performance. During the quarter, we were awarded IFR Asia's Asian Bank of the Year and the India Bond House Award for our breadth of coverage and depth of expertise in the Asian investment banking space. In slide 5 of our presentation, we have listed our awards and achievements across various segments. The winning mindset is also seen in our business performance with multiple all-time highs that we have recorded during the year. New granular liability relationships acquired have continuously trended upwards over the last 3 years, touching new highs. In Q4, we opened 2.4 million liability relationships, up 30% year-on-year, taking the total accounts opened in financial year 22 to new highs of 8.6 million, up 29% year-on-year. We added highest number of salary accounts during the year, 1.5 million new accounts with all-time high balance contribution from them, reflecting growth in both quality and quantity. On the wealth management side, We saw highest ever gross mutual fund sales of over rupees 21,200 crores and alternate investments of rupees 2,300 crores in the year. We issued our highest ever quarterly new credit cards at 1.1 million in Q4. In February 2022, we were the largest issuer of credit cards on net basis in the industry. We crossed a significant milestone of 2 million Flipkart Axis Bank credit cards in force. We also entered into a strategic partnership with Airtel that will help us to offer credit cards and various digital financial offerings to Airtel's 340 million customers. There are more partnerships in the pipeline. Retail disbursements of Q4 financial 22 were highest ever for any quarter, growing 21% year on year. The acquisition of Citi's consumer banking franchise further builds on this momentum and reflects our desire to win in our focus customer segments. Our One Axis philosophy has been a key area of distinctiveness in the wholesale banking segment. In SME, we have seen highest ever contribution from new business underwritten during the year at 53%. Similarly, in mid-corporate, we have seen high CAGR growth of 36% over the last 2 years. Our second pillar was strengthening the core. I start with building a strong balance sheet. Sustainability continues to remain the foundation of the bank's GPS strategy. We have taken concrete actions towards strengthening our policies, processes, and controls. Our legacy asset quality issues are firmly behind us, as the numbers show. Bank asset quality is among the best in class. Net slippages declined by 0.42% and 1.15% on QOQ and YOY basis respectively, and credit costs declined by 0.12% and 1.16% on QOQ and YOY basis respectively. GNPAs, NNPAs, and BB book are down by 244, 133, and 57 basis points respectively in the last 3 years at 2.82%, 0.73%, and 0.75%. We hold cumulative non-NPA provisions of rupees 12,428 crores and standard asset coverage ratio of 1.77%, amongst the highest in the industry, with one of the lowest restructured portfolios of 0.52%. Our balance sheet buffers remain strong with PCR of 35%. The bank's strong balance sheet and healthy capital with CET1 ratio of 15.24% ensures that we enter this cycle from a position of strength. Deepak Maheshwari, Bank's Chief Credit Officer, played a key role to help us establish the right underwriting framework and credit culture in the wholesale bank over the last 3 years. We had persuaded Deepak out of his retirement to guide us on this journey. He would be moving on upon completion of the contract on 30th April. However, he will continue as board member of Axis Finance. We sincerely thank him and wish him the very best. He has built a strong team that will sustain our credit and risk culture. Second, on strengthening the core was around building our next generation technology architecture. Technology is at the core of future-ready Axis we are building. We continue to make significant investments in building digital and new age tech capabilities, invest in talent, and work on transformation projects across our businesses. Our IT team strength has grown by 75% over the last 24 months with focus on modern engineering skills. Overall, our year-on-year tech spend has gone up by over 2x. On cloud, our leadership continues. We have been the first among peers to create 3 landing zones, AWS, Azure, and GCP, to support our multi-cloud strategy. We already have 55 plus of our critical applications on cloud. Our efforts to modernize the core received external recognition during the quarter, with International Data Corporation recognizing the bank as Asia's best infrastructure modernization program at the 2022 Financial Insight Innovation Awards. We have built Data Stack 3, which is a cloud-based, real-time, flexible architecture covering structured and unstructured data. We now have a rich nudge library towards making customer journeys more impactful and personalized. Further, through our initiative on universal underwriting, we are building capabilities to underwrite a significant section of the lendable population in India. Our third thing around strengthening the core was organization-wide transformation projects to accelerate our GPS journey. We have 19 transformational projects being managed directly by our management committee members. The strong rhythm and rigor that we have built across our distribution engine, led by these transformation projects, are reflecting in our acquisition numbers. Now let me talk about building for the future. Investments to position ourselves firmly for the future continue. Digital continues to be an area of relentless focus. The impact of this is now visible across the business segments. This quarter, We launched new digital lending programs, including account aggregator-based lending, usage of alternate database underwriting programs, etc. New products that we launched continue to see good traction. BNPL witnessed quarter-on-quarter growth of 50% in GMV for the quarter. Retention rates are very healthy at 70%. Plus, digital merchant cash advance, a new product we launched in quarter 3 this year, targeted at small merchants, has witnessed 12x quarter-on-quarter growth in terms of volumes. 68% of our FDs are open digitally. We have launched new-to-bank FD opening on our platforms and also with our partners. We have now entered into over 80 partnerships at both product-specific level using APIs and wide-level banking. We have 300-plus APIs among the largest set of open banking APIs for external partners now. On UPI, our market share stood at 15%, and we manage more than 25 million transactions daily, with amongst the lowest rate of technical declines for emitter transactions. We now have 5.6 million non-Axis Bank customers using our Axis Mobile and Axis Pay apps. Our corporate digital project NEO has made strong progress, and the first journeys have gone live in quarter 4. The second pillar on building for the future was around bank-wide program to build distinctiveness. During the year, we launched SPARSH, our Customer Experience Transformation Initiative. This is a multi-year program to embed customer obsession across the bank and building distinctiveness. The Bharat Bank initiative is running ahead of timeline. The Bharat Bank segment delivered a strong 34% quarter-on-quarter growth in disbursements in quarter 4 financial year 22. We also achieved highest ever monthly disbursement in March 22 across all the major product segments. The bank is working towards expanding its footprint in rural and semi-urban geographies by using the existing VC network and leveraging the vast network of common service centers. Over 40,000 plus village-level entrepreneurs have been identified as business correspondents across 2,065 branches. ESG has bank-wide sponsorship. During the year, we saw an improvement in our ratings across assessment platforms like S&P, Dow Jones, MSCI, and CDP. We featured in the prestigious FTSE For Good Emerging Index for the 5th consecutive year in 2021. During the year, we entered into $300 million loan guarantee program with Guarantor towards accelerating the e-mobility ecosystem in India. Also, we recently signed an initial outlay of $150 million partial guarantee facility agreement with the Asian Development Bank to support supply chain financing with focus on ESG and priority sectors. Further, the bank has also committed affordable finance of up to $150 million through Samrit, an initiative supported by the United States Agency for International Development towards strengthening India's healthcare infrastructure. Before I conclude, let me touch upon the key financial highlights for the quarter. Puneet will, of course, provide detailed updates. On a sequential basis, our performance has been strong. Key growth measures quarter over quarter are as follows. CASA growth of 7% period end basis, deposit growth of 6% period end basis, retail assets loan growth of 9%, Bharat Banking loan growth of 34%, fee growth of 12%, core operating profit growth of 8%, and PAT growth of 14%. This is all quarter over quarter. The above performance has been a direct outcome of our rigorous execution of GPS strategy over the past 3 years and the initiatives that I just highlighted in the earlier themes. In closing, we have strong momentum going into financial year 23, and we will continue our steady upward movement on business and financial metrics. There is a positive cultural change within the bank. We remain optimistic and confident about our future. I'll now request Puneet to take over.
Thank you, Amitabh. Good evening, ladies and gentlemen. Thank you for joining us this evening. I'll discuss the salient features of the financial performance of the bank for Q4FY22 and FY22, focusing on our operating performance, capital and liquidity position, growth across our deposit and loan business, asset quality, restructuring, and provisioning. We have consistently stated that we are focused on strengthening our core businesses and ensuring that our balance sheet is resilient across cycles. I'm happy to state that we have been able to deliver on both objectives. Amitabh spoke at length on the progress made on each of our businesses and transformation initiatives and key sequential metrics. My focus hence will be on our financial performance. Our operating performance is robust. YOY improvements are reflected through growth in net interest income, operating profits, and PAT. On a sequential basis, business traction is visible through strong growth in granular retail fee, core operating profits, and PAT. Net interest income for Q4 FY22 stood at 8,819 crores, representing a YOY growth of 17% and a sequential quarter-on-quarter growth of 2%. Rupees 83 crores of net interest income was prudently reserved as it related mainly to realized interest on an NPA investment account where principal is still outstanding, a contested arbitration order where interest has been awarded against the bank, and some miscellaneous items. This has adversely impacted NIM for the quarter by 4 basis points. NIM for Q4 FY22 stood at 3.49%, at the higher end of our indicated range last quarter of 3.45 to 3.5%. NIMs declined sequentially 4 bps and 7 bps respectively. Improvements in NIMs over the medium term will be driven by balance sheet mix shift from investments to loans, and within loans, the currency segmenting and product composition towards better yielding assets, continued improvement in low-cost deposit base and the quality of our deposit franchise, and reduced share of low-yielding RIDF bonds. At 3.54% of assets in March 22, down from 4.75% of assets as of March 21. The improving liquidity franchise has resulted in cost of deposits declining 25 basis points YOY. The bank has been improving the risk profile of its loans. Our NII as a percentage to average risk-weighted interest-earning assets stands at 7.11%, improving 20 basis points YOY. Non-interest income for Q4 FY22 stood at 4,223 crores, representing a YOY growth of 19% and a sequential Q1Q growth of 10%. Our fee income stood at 3,758 crores, growing 12% Q1Q. 91% of our fee is granular. The fees for the quarter is after giving effect to some customer-focused actions taken by the bank, including reducing fee across many charge types, mainly in the retail liability area in Q3. Despite that, total retail fee grew 14% YOY and 14% Q1Q. Fees on retail assets excluding cards grew 41% YOY, 16% Q1Q. Fee from third-party distribution grew 23% YOY and 31% Q1Q. Our transaction banking fee grew 11% YOY and 6% Q1Q. Our commercial banking business group fee grew 4% YOY and 38% Q1Q. Operating expenses to average assets stood at 2.17% for Q4 FY22, within our indicated range of 2.2% that was called out last quarter, higher by 21 basis points YOY and 2 basis points sequentially. Operating expenses for the quarter stood at 6,576 crores, growing 23% YOY and 4% sequentially. The sequential quarter-on-quarter increase in rupee crore expenses can be attributed to the following reasons. 47% of the growth is linked to volume, 51% to one-time expenses, 17% attributable to collection expenses. This has been offset by BAU and statutory expense savings by 15%. One-time items for the quarter relate to reclassification of provisions into operating expenses and the proposed Citibank acquisition-related expenses debited to the P&L. Our technology spends grew 56% YOY. Technology spends stand at approximately 8% of our total operating expenses. Staff costs increased by 13% YOY and declined 3% quarter-on-quarter. We've added 7,500 people from the same period last year, mainly to our growth businesses and our technology teams. We have continued to maintain the Social Security Code provisions. The cumulative Social Security Code provision in the books of the bank now stands at 225 crore rupees. Other operating expenses grew 27% YOY and 7% Q1Q, mainly attributable to higher business volumes, higher collection expenses, one-time transaction expenses relating to the business purchase transaction. The YOY increase in rupee crores on operating expenses can broadly be bucketed to the following reasons. 38% is volume linked, 24% is attributable to investing in the future growth of the franchise and our technology related spends, 11% is attributable to collection expenses and statutory expenses, and the balance 27% constitute BAU growth. Operating profit for Q4 FY22 is 6,466 crores, growing 13% YOY, 5% Q1Q. Core operating profit for Q4 FY22 is 6,235 crores, growing 9% YOY and 8% Q1Q. Provisions and contingencies for the quarter were 987 crores, declining 54% YOY and 26% Q1Q. The provisions and contingencies for Q4FY22 include prudent additional provisions of rupees 576 crores. The bank has not utilized any of its COVID-19 provisions in the current quarter. This is entirely prudent and in no way a reflection of the credit risk on the books of the bank. The annualized credit cost for Q4FY22 is 0.32%, declining 116 basis points YOY and 12 basis points Q1Q. Profit after tax stood at 4,118 crores, growing 54% YOY and 14% Q1Q. Annualized Q4 FY22 ROE stood at 15.87%, improving 415 basis points YOY and 168 basis points Q1Q. The strength of our balance sheet is reflected through the cumulative non-NPA provisions at 31st March 2022 at 12,428 crores, comprising COVID-19 related provisions of 5,012 crores, restructuring provisions of 1,411 crores, which are at first bucket NPA rates, and weak assets and other provisions of 6,005 crores. Our provision coverage, all provision NPA plus non-NPA divided by GNPA, stands at approximately 132%, improving 1,188 basis points YOY and 212 basis points Q1Q. The bank is well capitalized in carrying adequate liquidity buffers. Our total capital adequacy ratio, including profits for 12 months ended 31st March 2022, is 18.54%, and our CET1 ratio is 15.24. The prudent COVID provision translates to a capital cushion of 60 basis points over and above the reported capital adequacy. Our average LCR ratio for the quarter was 116%, increasing sequentially by approximately 150 basis points Q1Q. Our excess SLR stands at 96,190 crores. The risk-weighted assets of the bank as of 31st March 2022 stand at 61%, compared to 63% as of December 2021 and 64% as of March 2021. This improvement in RW is reflective of the quality of the business being done by the bank. Growth across our liabilities and loan franchise. Amitabh discussed the strong progress made on the liability franchise in his opening remarks. Please refer slide 21 and 22 for further details. Our overall loan book grew 15% YOY and 6% sequentially. The loan book continues to...
There are more than 20 parties in the conference.
With retail advances constituting 57% of the overall advances, corporate loans at 32% and CBG at 11%. The retail book represents healthy characteristics with 80% of the retail book being secured. Retail loan book grew 21% YOY and 9% sequentially, led by secured products like home loans growing at 18% YOY, LAP at 29% YOY, and our small business banking business growing at 60% on a YOY basis. Disbursement to unsecured products continued to grow, with personal loan disbursements growing 23% YOY and 24% Q1Q. Wholesale banking. We have progressed well in our endeavor to build a profitable and sustainable corporate bank. The wholesale book grew 4% YOY and was flat quarter on quarter. Details of rating composition, incremental sanction quality are set out on slide 41. We continue to have strong positioning in GST and RTGS payments with a market share of till 9%, approximately 9% each. The offshore wholesale advances, which are largely trade finance related, grew by 42% YOY. The growth in our overseas corporate book is primarily driven by our GIFT City branch exposures. 96% of the overseas standard corporate loan book in GIFT City branch is India linked and 94% is rated A and above. Our commercial banking book grew 26% YOY and 13% sequentially. Our commercial banking card deposits on a quarterly average balance basis grew by 25%. The overall fee from the CBG business increased 38% sequentially. CBG customers contributed 24% to our Burgundy franchise in terms of Q4 sourcing. Each of these reflect the quality of the strong relationship-led franchise we are building. Our ECGLS share is low and dominantly to ECGLS 1 and 2. Asset quality metrics in the CBG segment have held up well, with net slippages of 85 crores, negligible restructuring, and substantially improved provision cover for this segment to 75% as of March 2022 from 52% at the end of March 20. Coming to the performance of our subsidiaries, Detailed performance of our subsidiaries is set out on slide 70 to 76 of the investor presentation. The One Axis strategy is playing out well. Subsidiaries contributed 80 basis to the consolidated Q4FY22 annualized ROE of 16.67%. The domestic subsidiaries reported a net profit of 1,195 crores, up 44% YOY. This translates into a return of investment of 54%. Axis AMC has been one of the fastest growing AMCs in the last 3 years, with average AUM growth of 32% and 43% in FY22 and the last 3 years respectively. Axis AMC full year PAT grew 47% to 357 crores. Axis Finance delivered strong growth on a full service customer focused franchise offering retail as well as wholesale lending solutions. In FY22, disbursements grew 67% YOY. Around 31% of these disbursements are from the retail segment, with the retail book at 33% of total loans, up from 3% in the last 2 years. Within wholesale, focus remains on well-distributed granular book. 75% of the corporate book is A- and above in Axis Finance. Axis Finance's book quality continues to be strong with a net NPA of 0.46% and negligible restructuring, commendable for any NBFC in this space. Axis Finance's FY22 PAT grew 72% to rupees 364 crores with an ROE of 20% and a healthy capital adequacy ratio of 20%. Axis Capital continues to maintain its position amongst the top ECM segment. It completed 44 ECM deals. Its PAT stood at 200 crores, up 20% YOY. ROE improved from 16.4% to 32.8% in the last 3 years. Axis Securities, the broking revenues of Axis Securities grew 36% and 56% for Q4 and FY22 respectively. Its FY22 PAT was up 40% and ROE improved from 15.5% to 38.7% in the last 3 years. Our direct exposure to Russia and Ukraine domiciled companies and students studying in these geographies is negligible and stands at an absolute value of rupees 21 crores. Overall asset quality has been improving sequentially for the bank as we had indicated last quarter. The GNPA, NNPA and PCR ratios for the bank and segmentally for retail, SME and corporate are provided on slide 59. The GNPA at 2.82 improved 88 basis YOY and 35 basis Q1Q. Net NPA at 0.73%, improving 32 basis YOY and 18 basis Q1Q. At March 31st, 2022, we have nil net exposure to ILFS entities, the 3 future entities, Shrey entities that are being reviewed by RBI. Healthy provision cover of 75%, improving by 237 basis points YOY and 269 basis points Q1Q. Gross slippages for the quarter were 3,981 crores, lower by 25% YOY and 4% sequentially. Gross loan slippage ratio for the quarter stood at 2.38%, improving 121 basis points YOY and 21 basis points Q1Q. For the quarter, 54% of the gross slippages are attributable to linked accounts of borrowers which were standard when classified or have been upgraded in the same quarter. The bank has a rule-based write-off policy for its retail and CBG business. The net slippages for the quarter for the bank as a whole would be negative 502 crores, adjusted for recoveries and upgrades of 3,763 crores and recoveries from written-off accounts of 718 crores. Consequently, the net NPA slippage ratio for the quarter in rupee crore terms is 218 crores, declining 75% Q1Q and 88% YOY. Net slippage ratio for the quarter on an annualized basis is 0.13%, improving 115 basis points YOY and 42 basis points Q1Q. On a segmental basis, retail net NPA slippage is 193 crores, CBG at 85 crores, and for the WBCG segment, we have negative net slippages of 60 crores. Standard COVID restructuring under 1 and 2 stands at 4,029 crores and is 0.52% of GCA, one of the lowest in the industry. Overall provision cover for retail for restructured loans stands at 24% with 100% provision for unsecured restructured retail loans. We collected 4% from the restructuring book during H2 FY22. BB and below for the bank declined 26% YOY and 18% sequentially. Upgrades and recoveries in the quarter aggregated to 1,671 crores, constituting 15% of the opening BB and below book. Downgrades for the quarter were 372 crores. More details of the BB below and restructuring have been provided on slide 60 of our investor presentation. For the full financial year FY22, the key numbers are as follows. NIM stands at 3.47% as compared to 3.53% previous year. NII stands at 33,132 crores, YOY growth of 13%. Fee stands at 13,001 crores, YOY growth of 22. Operating profit at 24,742, YOY growth of 7. Cost to assets at 2.17%. Credit cost at 0.72%, improving 96 basis points YOY. PAT stands at 13,025 crores, increasing 98% YOY. GNPA and NNPA declined by 88 and 32 basis points respectively on a YOY basis. ROE of 12.91% improved 536 basis points YOY. As I close, we summarize the bank's journey so far and the broad outlook on key performance drivers. Our balance sheet resilience is visible through strong capital adequacy, legacy NPA issues behind us with net NPA at 0.73%, limited restructuring at 0.52%. Consistency and quality of the granular liability growth is visible. Average CASA to average deposit ratio has improved to 43% on a month-end balance basis. It's up at 45%. Growth in healthy granular businesses, both secured and unsecured. Focused segments like retail and within wholesale, SME and mid-corporates with better ROE continue to grow faster at 21%, 26% and 45% respectively. Consolidated Q4 FY22 annualized ROE is at 16.67%. Domestic subsidiaries now contribute 80 basis points to consolidated ROE. We remain committed to invest for our long-term future and would not hesitate to spend more on transformation projects, upfronting technology investments and granular growth. This could then lead to negative impact on cost to assets ratio in the short term. We continue to closely monitor two key variables, geopolitical risk and its first and second order impact on inflation, liquidity and growth, and any potential future COVID waves and resultant government policy action thereon. We would be glad to take your questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Maruk from Edelweiss Financial Service. Please go ahead.
Yeah, hello. Hi. My question is, so I have 3 questions.
Maruk, sorry to interrupt you. Your audio is not very clear. May I request you to speak through the handset?
Yeah, can you hear me now?
Not that clear, ma'am.
But yes, go ahead. We'll try to decipher it, please. Go ahead.
Yes. So my first question really is that in terms of your cost to asset ratio, so the guidance you had given on standalone numbers of exit rate of 2% around in 4Q23, is that still applicable?
Maruk, thank you for your question. Yes, we had indicated previously that we will exit FY23 at a 2% cost to assets ratio. We've updated our commentary on the cost to assets, and like I said earlier in my opening remarks, we believe that this is the right time to invest for the long-term future of the franchise and make sure that we spend the right amount of money to deliver our transformation projects and get to upfronting our technology investments to support the granular growth you have seen through the last few quarters. And therefore, we do expect in the short term expenses to increase. As of now, we are moving away from the 2% exit guidance that we have previously provided, and we will guide at a future date on what that number could be. But as on date, we are not offering a updated guidance to the 2% number.
Thank you. And my last question is on your transfer of standard assets to ARC. Could you tell us what sector?
Maruk, we've not transferred standard assets to ARCs. We have one transfer, which is an NPA of 215.78 crores that we sold to an ARC in the quarter. That NPA was fully provided prior to sale, and we have an aggregate realization of 63.4 crores against that sale. So that's net accretive to P&L. That is the only asset we have sold to an ARC.
Okay, and just to repeat what you said, Shree and Future have a net exposure of 0 in your book, correct?
Yes, Maruk, that would be correct. Yes, Maruk, that would be correct.
Maruk, do you have any follow-up question?
No, thanks. Thanks a lot. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Rohan Mandora from Equirus. Please go ahead.
Hello.
Go ahead, sir. You're audible.
Thanks for the opportunity, sir. So in the opening comments, you indicated that the NIM expansion incrementally will be driven by mix changing on the asset side as well as from investment to advances. So, sir, if I do a back of the envelope calculation based on the LCR that you're disclosing of 116%, and there's a potential of 8 to 10 basis points of NIM expansion there. And other than that, on the loan mix side, how do we envisage the NIM expansion coming? So, like, which are the segments where we will look to grow faster? And also, would we look to take certain measured credit risk to increase the yields? So that's the first question.
Thank you for the question. Two parts to the response, which is our focus segments as we look to grow. On the wholesale side, we've called out is the mid-corporate segment. We've already delivered strong sequential quarter growth on the commercial banking segment that we have. So on the wholesale side, those would be the two segments that we will continue to look to grow in a granular fashion. On the retail side, we have previously said that we are comfortable now taking on incremental unsecured exposure. That should be NIM accretive, but I just want to clarify that all of our incremental NIMs will be accretive even on a risk-adjusted basis. So it is not that we will add NIM and add credit cost. On a net risk-adjusted basis, we will see an accretion to the P&L. That will be the loan segment shift that we alluded to in the opening comments. Further, we could potentially also have a currency composition shift where the rupee book grows faster than the dollar book, accreting to NIMs as we move forward. So those will be the asset side NIM drivers other than our RIDF book reduction that we spoke of. So those are the three drivers to the asset side NIM and yield improvement.
Sure, sir. So second was on the savings deposit. If you look at the number of accounts that have grown year on year, that's almost 35% increase. But if you look at the retail SA balances, that's gone up by 16%. So if you can share some details on how is the customer profile in terms of new accounts opened, and also what are the average balances there vis-a-vis the entire book average balances in the savings account?
Thanks for the question. I think the way we look at savings account is that any acquisition that we do during the year has always a phase lag in terms of how they build up balances. The approach to the savings book is not to focus too much on the account, but at the customer who is behind that account. And our approach is to see that we kind of look at it in terms of product penetration that we want to do with them. That is reflected in the kind of profile of customers that we want to acquire. And as you would have heard Amitabh and Puneet talk of, we are trying to move towards a profile which is also inclusive of the premier segments. And therefore, there is an uptick move in terms of the premierization that we are doing. and that gets reflected in the continuous growth that we are seeing in terms of the ticket sizes that are available. The savings account is also contributed towards the salary book. That is something that we are using as one of our focus areas as we go into doing some of the transformation projects that we are doing. And therefore, a combination of how we profile customers, how we scope the catchments in which our branches are, and look at including the premier segments also, plus an overlay of opportunities of salary corporates that we are catering to. So all this combines together to help us look at savings accounts. Thank you.
Sure, sir. Thanks. And last, one data keeping question. How are we placed on the PSL? And what will be the share of total deposits in the Burgundy AUM? Thank you.
So as far as PSL is concerned, this year we have met the PSL requirements for the second year in a row across all the categories. Obviously, whatever money we spent in buying certain certificates has obviously been taken through the P&L. We could not understand the second part of your question. You had some other question also.
What is the total deposits within the Burgundy AUM?
We don't disclose that amount separately. We disclose the Burgundy AUM on a consolidated basis. The Burgundy proposition and its delivery are set out on slide 37 of our investor presentation.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Adarsh from CLSA. Please go ahead.
Hi, Amitabh team. Couple of questions. One on the retail TD momentum. Can you explain what's happened? It's been quite sluggish, slow. Large part of the growth being funded by wholesale TD.
Adarsh, we are struggling to understand you. Can you come over to the phone? We're catching only bits of what you're asking.
Okay, sorry, I'll try and repeat that. So the question was...
No, much better. Please go ahead, yeah.
Yeah, Amitabh, the question was what's happening in the retail TD? The momentum's just been too sluggish in the last few quarters. A good part of the growth's been funded by wholesale TD.
So I think, Adarsh, thanks. What we are trying to do is look at retail TD as a vector where we are trying to address constitution-based approach. Our entire effort through the last couple of years has been to correct our approach towards the individual side. And while it is slow, but there has been some stock corrections on the constitution side that we have been parallelly doing. And a combination of that, hopefully as we go forward, a focus on the individual and small business elements will see us getting an improvement over the next few quarters. So that's the way I would put it. So it's a part correction as well as increased focus, which is going to take us there.
Sorry, can you tell me what correction, like what's the part that you felt needed a correction, and how long is that journey? Because it's like one of the most important numbers that we were highlighting, and it kind of been quite sluggish this year.
No, so the correction is based on the fact that our past few years, as we started this journey a couple of years back, our effort had been to ensure that we moved from what we call as constitution-based non-retail term deposits to individual-focused term deposits. And our product penetration on the term deposits in the individual space, as I mentioned in the earlier question on savings, is what we have been trying to, kind of get the engine moving on. And as we push that engine of growth on the individual TD side, we are definite that over the next few quarters, the retail term deposits will also start delivering.
So, Adarsh, what Ravi is trying to say in very simple words is that when we move towards constitution-based TDs, there are part of retail term deposits which are getting reclassified as non-retail term deposits. It's part of that journey to do constitution-based deposits. So when you look at the RTD, obviously that number is shows the lower growth, while an RTD shows a higher growth. So we are trying to correct it. But yes, the core growth, is there. But because of this reclassification, the number 10 is obviously muted. I hope you've got a drift of what we're trying to say.
Yeah. And Amitabh, the other question, a feedback and a question which, when we had this build-up in cost run rates over the last few quarters, I'm sure, you would know that we got to invest and it's a good time to invest. So what we're trying to understand is what's changed in a few months for you to not have visibility of how OPEX will pan out? Like what's changed in the last few months?
No. So I'll tell you, when we get traction, for example, I'll give you, where we're coming from. When you start getting the traction which we are getting, say, in our credit cards or NAB or retail asset space, or when you are investing in some technology projects which we believe we are getting the results, you have a choice to make. One is that do we not go for that growth and kind of be in a middling range and not have those expenses in place, or you actually go and spend that money upfront to some extent, and it reflects in long-term, the right kind of return on equity, the right kind of returns for you. So that's a choice we are making. We have seen great traction in the last quarter, and we are asking ourselves, does it make sense to stick to that number, or does it make sense to actually, if the positives come before us, continue to spend and get, obviously much larger, longer-term benefits? So that's point number one. Second, if you look at our net slippages, if we spend the right kind of money on collections, we are seeing a better return in terms of what we are collecting. Expenses are coming in the expenses line, the benefit is coming in some other line, right? So, we are continuing to meet our requirements for PSL, and obviously that also goes to the P&L. So there are some of these expense items where the choice is between sticking to a cost to revenue line or saying that, no, if we spend this, it's good for the long term and the return on equity for the bank. So that's the choice you're making. Nothing has really changed. We are seeing better traction. The momentum is there. And we don't want to restrain ourselves because we have talked about expense to revenue number. Hopefully we can balance it. When we have a better idea, we'll share it with you.
And is there a thought that because the credit cycle is like quite benign, right? Every bank's reporting undershooting of credit cost. Use some of that to to spend and invest. Is that also a thought that's probably a driving force to allow you to spend a little bit more?
I mean, we are very clear. We have worked too hard to get to this level of our assets profile and what kind of quality of assets we have created. So within the risk guardrails which we have set for ourselves, we do believe our positives exist. Our market share and advances had gone up to 6%. We do believe, and you look at the numbers, for example, in Bharat Banking. So we do not want to restrain some of our businesses by saying, because we have to meet a cost to revenue, guidance, we are not going to allow it to grow. So if the policies are out there, which we are seeing as we speak, we will grow, but within the defined risk guidelines. So I just want to be clear. This will not be at the cost of putting on, riskier assets for the sake of doing it because we have to deliver a certain growth. But yes, when we do it, there are some upfront expenses which are required. You have to invest in the infrastructure and resources. When you're working with partners, some upfront spend is required. And we will obviously be assessing each of these opportunities and deciding whether it makes sense to grow that much faster or at a lesser pace, which could mean that it would come in the way of our 2% cost of revenue. As and when we have a better idea, we'll share it with you.
Perfect. That's good, Amitabh. Thanks and all the best.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi. So the question was on the employee side. When we look at it, the quarter-on-quarter decline in the employee count, and we are seeing that impact even in terms of the lower employee cost. So what is actually getting into almost like 750 odd employee count being lower quarter-on-quarter?
Well, it just shows our ability to be able to manage costs when we want to. I think it was very important for us. We had invested in the business. It was important to ask ourselves, are the resources productive to the extent we want? Are we getting the whatever we need to get out of each of the resources? As a result, as the management team, we decided that we need to tighten our screws a little bit. And in that process, when we did that, we were able to obviously see a reduction in staff costs, which should tell you that we're not just throwing people at revenues. We are being very conscious of are we getting the right productivity in all of the businesses, and that's the mantra we'll continue to use in this current year and the years going forward. So everyone is being asked to justify when they're spending money as to how the productivity numbers are moving, and this obviously includes both costs of people employed by the bank directly and through outsourcing. So that is being watched very, very carefully.
Sure. And secondly, in terms of this notes to account, wherein there is the loans which are transferred on the corporate side. So what is the nature of these loans, and is anything to do with the provisioning? Because last time when we look at it, standard and the non-NPA provisioning was 13,400. Now that is down to 12,400. So what is the impact of that 1,000 odd crores which is coming off on a quarter-on-quarter basis?
So Kunal, two things. First and foremost, let's talk about the standard asset provision. You would recollect that at the end of Q4 of last year, we had 100% provision on security receipts. So we had a security receipt portfolio that carried 100% provision reported on a net basis. The reduction in the standard asset provision is nothing but a markdown of that portfolio. So we've netted the provisions off against the investments, and that has caused the reduction in both the SR figure as well as the standard asset provision number. So there is no utilization, it's a simple markdown. Your second question, in the UFR of corporate segment assets transferred, first and foremost, they are standard assets that are transferred. Second is, if your reference is to the 5,068 crore number, it's principally our syndication business. It's loans that we underwrite and then syndicate by virtue of novation. That is the outflow disclosure as required by RBI. So there is an inflow number and an outflow number, both relate principally to our syndication business.
Kunal, do you have any follow-up question?
Yeah, just one last question in terms of when we look at the net NPA and the BB and below book and the overall provisioning that we are carrying, and the trend has also been declining. Are we very much confident in terms of how the credit cost would pan out, and would we like to give some guidance for FY 23-24, because it has surprised also over last 3 quarters?
Kunal, before Puneet answers the question, let me just say that I want to emphasize the point. Today we have reached a point where we believe, when we compare ourselves to some of the other players, our asset quality is best in class, our provisions are some of the highest, our restructuring book is the lowest. And it is not driven by what we are seeing in our portfolio, it is driven by our desire to become a conservative financial institution in terms of what policies and procedures we follow. I just want to register this point, is very, very important, because we've worked very hard to get here. Puneet, now you want to add to the numbers.
Kunal, I think Amitabh's covered the response to your question on guidance. We don't offer guidance.
No, but having said that, maybe now we are well covered, so the confidence would also be high in terms of managing it well over next couple of years as well, looking at the last couple of quarters trajectory. Yeah.
So boss, I've said in the opening remarks, and so please know we remain optimistic and are confident about our future. We have said it.
Okay, sure. Thank you. Thanks and all the best. Yeah.
Thank you. The next question is from the line of Parag from White Oak Capital. Please go ahead.
Yeah, thank you. Just extending the cost to asset thing which you have mentioned, that it is difficult to give any guidance, but I just want to know that in near term, what happens to the return ratio? So what, main thing is, basically, let's say your cost to income ratio, kind of remains elevated for few more quarters or a year. Will you be able to manage the overall return profile through some other line items, or you think that in a near term the return ratios outlook also will kind of come off with respect to cost of income ratio staying elevated?
Thanks for the question. I think one, we stay committed to the aspirational ROE of 18%, which we set out. We stay committed to the fact that we have visibility of 16.5% ROE. And despite our comments on cost, we believe both of our earlier comments stand steady over our plan period. Therefore, there is no revision to the ROE numbers that we are endeavoring for.
Okay, not even the tenure in which you want to attain that?
Like we previously said that we do our planning over a 3-year period. The aspirational ROE of 18% is over a 3-year plan, so 23 to 25. Visibility of 16.5 exists as on today for the plan period. Therefore, with that comment, we are not revising the tenor of our aspiration or our visibility, despite continuing to invest in the business.
Sure. Thank you, Buddy.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. I have 3 questions. One is on your Airtel co-branded credit card tie-up. So clearly this is one of its own kind. Airtel does has a large captive customer base. If you can share the economics and what kind of milestones are you looking here for Axis Bank perspective?
See, clearly we started this journey with the largest, Sanjeev Moge, I take care of card business. So we started this journey with the Flipkart partnership, which we started from July of 19. Since then, we've struck a large partnership with Google as well. And Airtel was a large opportunity which we cracked, this is around mid of last year. Since then, we were able to launch this card in a period of 6 to 7 months. It's a very large franchise. Obviously, all of us are very, very well aware of Airtel. We believe with the capabilities we've developed on risk, on technology, and experience for the customers, we have the ability to forge a winning partnership with Airtel. It has just started. It's been less than 60 days. Actually, we launched it somewhere around I think around 10th of March or so. So it's been only, as we talk for the results, first 20 days of March. We see a healthy traction and we will continue to see gains as we go along. You want me to elaborate something more? I'm happy to do it.
Jay, do you have any follow-up question?
Yeah. So I do have. So, okay, sir. So if you can highlight by within what period probably this product will become break-even, or is it any how does it serve the entire ecosystem approach kind of a thing? If you have an answer for that as of now, and has the Flipkart has already sort of got into the break-even zone, or how quickly can it get there?
We don't discuss product level financials any which way on this call. I think what you should know is Flipkart has touched 2 million cards right now. It's part of our declaration this quarter, and we launched it in July of 19. Obviously, this period was also in the midst of COVID wave 1, COVID wave 2, etc. Those issues, if we don't anticipate, we anticipate Airtel to be at the same trajectory or faster than what we've seen on Flipkart. That's as much as we can put out right now.
Sure. And second question, sir, if you can highlight the gross slippages, and you have given, of course, given the net slippages, but if you can give the gross slippages on corporate, retail, and SME, that would be very useful.
If you look at it, our retail versus wholesale gross slippages would be 63% retail, 37% wholesale, which is wholesale plus CBG put together. I would again like to point out the fact that against the 3,981 crore gross slippage number, we have recoveries and upgrades of 3,763 crores. We have recoveries from written off pool of 719 crores. Consequently, net for the quarter, we are negative 512 crores. If I ignore the recoveries from the written off pool, for the quarter, we have a net slippage of an absolute value of 218 crores. I think it's important to put the gross and the net in the same context. Additionally, 54% of the gross slippage is attributable to linked accounts that were standard when classified as slippage, plus other standard accounts that slipped and recovered in the same quarter. So that is the context that we would request you to read the 3,981 crore number in.
Sure. And the last question is, sir, you have identified a few focus segments, which includes SBB and rural. And of course, we are seeing very strong growth there. If you can talk about this in slightly more detail, that is this sort of a low base and hence such a high growth? B, would this, I mean, rural is this what all products would it include? And SBB, I think, is a normal business banking, or is there anything more in these two products? Thank you.
Hi, this is Sumit here. So SBB for us is small business banking. It's typically comprising 80% of secured business, which is less than 1 crore ticket size, average ticket size of about 65 lakh, and that's secured. And it also comprises of the balance 20% is the unsecured business installment loan. Both are strong business segment for us, and we would like to grow them. The numbers speak for themselves, and we continue to invest in these to have good growth ahead. And these are closed business, so you can imagine it creates a very strong value proposition at the entire banking level. Thanks.
Hi, this is Manish Sharda. Rural is a part of a Bharat Banking initiative where we are trying to drive higher business growth in the rural and semi-urban markets in the country. The initiative covers all the products of the bank serving the segment of customers and the geographical segments in this market. So all the rural lending products like farm finance, farm equipment finance, gold loan, microfinance products, etc. All the retail assets and liabilities in the rural and semi-urban markets are part of this initiative. We believe that driving this deeper into this market will help us achieve our higher growth ambition, higher NIM ambition, help us get more accretive PSL business, as also drive more liability growth in these markets.
Sure. Thank you, and all the best.
Thank you. The next question is from the line of Nilanjan from Nomura. Please go ahead.
Hi. I hope I'm audible. So quickly on that recovery on return of assets, where is it coming from? Any color?
Hi Nilanjan, if I get your question right, you wanted to know where is the recoveries from the return of pool coming from?
Yeah, it's a very large item. So any specific situation that we had because of which this recovery came through? Any sector?
So Nilanjan, I think the way we would expect you to think about it, this is close to 65% of the recoveries from written off accounts have come in from the retail segment, and the balance is coming from the corporate. Broadly, it would be a couple of large accounts on corporates that have ended up being recovered. And in retail, it's broad-based recovery from the written off pool.
Right. The reason for asking this question, Sumit, is, I mean, if you have been articulating that, we will not restructure more and we will basically take the hard path of reclassifying assets and the linked accounts as NPLs. So the question is, assuming this is the path we have taken, do you see more and more upgrades? At some point, the proof in the pudding, what you have been saying, has to materialize. So is there a steady run rate on these numbers that we might expect going forward?
So Nilanjan, thanks for the question. I think the way you can look at it is in quarter 3, our recovery from written off accounts was 800 odd crores. We've done a similar number in the current quarter. So to our commentary that we've let accounts slip and then provided for them, but continued our endeavors to recover from the customers, is demonstrated across multiple quarters of higher recovery amounts. So we do think that that's something that we will continue to pursue on a go-forward basis too. The outcomes will get reported at every quarter end.
Right. And accounting-wise, this sits under other income, right? Not in the provision line.
Under the new RBI circular, it sits under the provision line.
This is under provisions. Okay. And there's one thing I kind of want to highlight. I mean, the guidance that you are putting out on ROEs. I mean, don't mind me saying this, but it's looking like a little 1 year roll forward every time. And I think if we have sort of been maintaining about 16.5 is what is visible, and the rest will come at certain conditions being met. Will we ever, forget about 18, but even getting to 17, is there a hope that we'll get there?
So Nilanjan, I think the way you need to look at it is what I called out for FY22 full year performance. I had said that we are at 13%, which is 12.91% full year FY22. We were at 9% last year. So there is a 536 basis points improvement in ROE year on year, which in some sense should clearly substantiate to you that the journey is clearly underway. That's one.
Mm-hmm.
Second is, in the course of our call today, we specifically called out the fact that the consolidated bank ROE Q4 annualized is 16.67%, which again demonstrates the fact that when we said we had visibility of 16.5, there is demonstration of that visibility, fully taking into account that Q4 is sequentially a strong quarter, but it should give you comfort that when we say visibility exists, we meant visibility existed. To your last point that we have extended the guidance of 18% ROE by 1 year on a roll-forward basis, our GPS strategy is a 3-year strategy. We have consistently maintained from March 21 that we will get to the 18% ROE over our planned period, which was FY25. We stay true to that, and that is the aspirational number that we will work towards. So I think that's the 4 parts to your answer to your question, but I'm happy to take a follow-on if I haven't been able to address your question.
Look, I'll take the follow-on offline. But a final question, it does look like the overall system is a little bit sluggish, irrespective of, inflation-driven capital requirements, etc. As a management or, driving business, which side of the balance sheet is getting more difficult, at least at this point in time? Is it the asset side or the funding side or the granular funding side?
Well, from our perspective, as we stand today, nothing looks sluggish. But yes, as you very rightly pointed out, things are getting tough because of the war and the second and the third order impact of that. The driving force for us to get the numbers right finally would have been the deposit growth. So we need to get that right. Once we get that right, we believe our engine can follow up with a certain amount of asset growth relatively easily. I mean, I'm not saying it is easy, relatively easy. So deposit growth is the key number for us, and obviously we need to drive it. We don't want to drive deposit growth just for the sake of it. We are very clear that we need to drive granular deposit growth, and that's what we're working hard towards. Do we see something today which is really bothering us? Not as of now, but obviously we have to be very, very watchful. Everyone is, bringing the economic growth forecast down for India. Inflation is rising. Interest rates are, as predicted by a lot of people, are expected to rise. The consumer inflation will hit people, which could reduce to lower expenditure, and so on and so forth. So yes, we are watching that space quite closely. Let's see how that pans out.
Perfect, Amitabh. Thank you.
Thank you.
Thank you. The next question is from the line of Krishnan from HDFC Securities. Please go ahead.
Yeah, hi. Are you able to hear me?
Yes, sir, we can.
Yes, we can hear you.
Thank you. Yeah, sure. Thanks. So just one particular point which has been structurally visible with Axis, and just wanted your views on that, was more around the fact that you have worked very hard to get to the asset profile and the asset mix and the shape of the asset quality that you have gotten over the last 4 years. And because of that risk-off approach, pricing power on the asset side something that you're finding difficult to probably imbibe? And hence, are you having to work too hard on the cost side? That's what I'm trying to get at.
See, I think if you look at what I had said, the focus is really on increasing NIMs and focus on delivering 18% ROE. And so therefore, in an environment where pricing is extremely competitive, particularly at the short end for the larger corporates, our strategy of building out a granular book through our SME, i.e. CBG, and mid-corporate is working well. And so therefore, it's not a question of risk aversion. I think the point that the previous speaker spoke about is that in general, the credit risk environment is benign and is expected to be benign into the foreseeable future. The issue in the large corporate space is really about pricing. And I think pricing, we do believe, will begin to improve when credit growth, particularly in the large corporate side, begins to increase, A. And B is when repo rate, etc., begin, the first sign or first action by RBI will start to my mind, begin to improve pricing on the large corporate side. Having said that, we continue to deepen our relationships with the large corporates. It's not as if we are not doing business with them on other fronts. Amitabh mentioned the fact that our One Axis strategy is working well with the large corporates, and we are now the IFR's Asian Banker of the Year. We continue to serve our customers across the capital structure, whether it is domestic equity, global bonds, local bonds, loans, etc. So some of these fees are sitting in our own fee line, and some are sitting in, for example, in Axis Capital's fee incomes. And therefore, as long as we're able to deliver sustainable ROE with these relationships, we're quite satisfied.
Okay. The other query I had was around the cards business. I know there was a little bit of discussion around this, but just the acquisition of the Citi portfolio, right? It's a great asset to have at probably a good price as well. But generally, your approach towards running the cards business has again been a little risk averse. You have stuck to existing to bank customers. How are you sensing your own maturity in that business in terms of being able to re-risk the portfolio?
Okay, I'll not touch anything on Citi because that deal will take some time to actually fructify. I'll just talk about our strategy. We went cautious on risk in FY21 as we saw the risk profile change. With COVID, first as the wave came in, it impacted the economic cycle in the country. We went cautious at that point of time. As we have seen that change in FY22, we have taken steps ahead. You can look at our acquisition momentum for last quarter 3, we did 7.5 lakh plus cards, highest ever for us. This quarter we've done 1.1 million plus. We are confident the number of cards we put out in March is the highest in the industry ever. So these numbers are strong. What we have now with our portfolio, with our partnerships is a very solid momentum which we expect to continue. Second, we used to be a ETB dominant acqui channel focus. Today, 30% plus of what we do is not existing bank customers. They are what we call some part NTB, which is new to bank, acquired from the market, but through a very different channel. It's not DSA sourcing, etc. Second part, what we call known to bank, which is people known to partners of ours. They could be customers of Flipkart, they could be customers of Google, they could now be customers of Airtel as well. Between these, we believe the risk profile is much better than what we see in NTB. However, the spend and usage patterns are very, very healthy. We believe this strategy is going to work. Risk profile is good, spend pattern is pretty good, and the momentum we have seen right now in Q3 and Q4 will continue. We have not been risk averse. I don't know where that's coming from.
Okay. No, I mean, I just meant the number one on the ETB, NTB, and also the fact that leverage, consumer leverage on our portfolio is generally a little lower. But anyways, I mean, I think you have answered both of these. Thank you.
Thank you very much. I now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, ladies and gentlemen, for taking the time to speak with us this evening. Please do reach out to us if there are any questions that remain unanswered. We'd be happy to take them on and address them at a future date. Thank you. Have a good evening.
Thank you very much. On behalf of Axis Bank, thank you for joining us. You may now disconnect your lines. Thank you.